The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast. Thrilled to have on a member of a team that is, if you're in this industry, you probably have heard of Lone Star Capital, Mr. Rob Beardsley, the captain of the ship there, based in New York and investing in Texas and Phoenix, if I'm not mistaken. And we'll let Craig kind of give us all the details into that end of things. But Craig McGrouther is with us today, and he's the director of business development at Lone Star. Lone Star has acquired over $350 million of multifamily real estate. That's probably an old figure too. Is that right, Craig?
Yeah, we actually, and thank you so much for the introduction. We actually just acquired a $105 million deal that closed last week, which we're really proud of. So now we're just out about, I want to say, maybe a hair shy of $500 million now.
That's awesome. Yeah, that's so cool. So obviously, a very high performance, highly successful, highly visible team that does a lot for the community as far as education and coaching. Rob Beardsley himself is one of the Raise Masters coaches that, as you all know, I'm a part of that mastermind. And so he, gives a lot. He wrote a book, and he's just got incredible people around him. And I've had the pleasure of having a couple of his team members on now. Never had Rob on the show, but one of these days, I guess. So Craig, welcome to the show, man. Super glad to have you here.
Thank you so much for having me. It's a pleasure. We got connected, I think, for the first time in person because I see you everywhere, of course. Just like we're visible, you're very visible as well. But we got the pleasure of connecting at BEC, which was great. Back in, I want to say, March of 2023. So just, about in Q1 or Q2. But pleasure to be on here. Thank you for having me.
You're welcome. Yeah. So BEC for listeners is best ever conference, which was in March in Salt Lake City this last year in 2023, coming up in April of 2024, also in my hometown. I'll claim Salt Lake City as home at this point. As most of you know, I'm from Cincinnati, went to college in Ohio, and then moved to Utah after college, and have been here for 24 years and definitely home now at this point. But so the best ever conference really does, in my opinion, live up to its name. It's number one on my top 3 most important conferences to attend. If you want a copy of that list and also a list of some other resources that I think are really pivotal and foundational, email me, tate@glequitygroup.com. Happy to send that to you. But these national conferences, like Best Ever, for instance, Raise Fest, you mentioned as well, I think earlier, they're such game changers and are so pivotal in the sense that every time I go to one, I come home and I feel like we just like really leveled up as a company in terms of like our network. Your network is your net worth, right? Or net worth is your network, or however that goes.
Right.
And so you feel like you level up there. You level up in terms of knowledge. Certainly, in the way of inspiration and then of course just the connections are tremendous. I apologize about my dog in the background here. Give me just a sec. So bottom line is, like, get to these national conferences, guys, because they will elevate you. They'll elevate your business. You'll meet people like Craig. You'll meet people like me. You'll meet people like Rob Beardsley. Like Joe Fairless is of course the guru behind that particular conference. And the list of names just goes on and on and on, especially at that one. Everybody's there.
Well, and to your point, this is kind of funny, and not a lot of people know the story, but that's where Kent met his business partner and the other key principal of Lone Star Capital. So Rob actually, naturally is the key principal, the founder, but there's another, person to the team that is not really as much in the spotlight. That's Kent. And Kent is kind of on the operations side, asset management side, property management side. And that's where Kent and Rob actually became acquainted, believe it or not, which is nuts to say, that they met at literally a, meet your partner kind of part of the event. And here we are, $500 million later, 5 years later in business, almost going on 6 years now. So to your point, you elevate your network from going to these events. You can meet potential business partners, but I'm sure you, Tate, just like us, we go to these events and we leave with a lot of equity. So we go to these events, we see all of our fund managers that are there. We see a lot of new partners, people that have maybe seen us on LinkedIn, whatever it may be. It's a really great way to, be a part of the community, because community is so important. As you know, these are the kind of the who's who's. And I'm sure you like me are so competitive. I don't want to go to these events and have, frankly, other operators take ground on, the relationships that we're working on too. Right. So selfishly, I want to be in the room just to make sure I don't fall behind.
100%. Yeah. You gotta stay top of mind. Right. And if you're not there, then they're going to be talking to somebody else, and no fault of their own. They're not going to be thinking about you first and foremost, like you would. Yeah. Like you would. But that is an amazing story, actually, that Rob and Kent, I'm looking at Kent's picture and his headshot on the website now, and that's quite a story that they met at Best Ever 5 years ago, and like you said, $500 million later, 5 years later, that's $1 billion a year, guys. If you do the math really quick on that, that's amazing stuff. When did you come on board with Lone Star, Greg?
Yeah, so I became very good friends with Rob in 2020. During COVID. He was in New York, I was in Phoenix, and naturally Phoenix is a little more open. We had a mutual friend that was my roommate. We started talking about real estate every single day, and then we kind of talked about how I would want to kind of get into the world that he's in right now, which is the syndication space, and kind of transfer from my real estate background into the firm. We were talking basically for over, I want to say a year prior to me joining the firm and the team. And then I officially started in January of this year, but was, going to conferences and meeting people and kind of becoming familiar with the jargon and the slight nuances, and kind of figuring out the underwriting process and spreadsheets and all that good stuff starting in June of 2022. So about a year and a half, or a little over a year and a half, but then formally this year to start.
Yeah, nice. Congratulations. What an awesome firm to jump on board with,
Yeah. And to the point, I wouldn't have just left what I was doing before. Prior to this world, I was selling homes, and that was a great career path. And I would have only left for an opportunity that was incredibly unique and special. And this is what I found was like, this is a once in a lifetime opportunity to take. The fact that there wasn't a salesperson really, or a business development representative before, was crazy to me in hindsight. But I naturally jumped all over the opportunity and kind of, spoke it into existence, if you will, because I was kind of in Rob's ear saying, hey, when it opens up, let me know. And finally it did open up, and I was lucky enough to be able to capitalize on the opportunity.
So what is a director of business? What is a director of business
development?
Growth? Development.
Business development. I mean, same effectively the way it is. And kind of the way I explain it to people is, Rob's obviously a very hyper productive and also busy person. So any way I can kind of lighten his tasks is one thing. But, one thing that I would do is a lot of investor relations, making sure the capital stack is filled, speaking with new investors as they come in for our new investor forums, reaching out and, connecting on podcasts like this, speaking with great people like yourself, kind of spreading the brand, and then also making sure there's always new new fund managers and co-GP partners or JV equity folks that we're speaking to and that we're actively looking to raise capital and money from. So a little bit of everything. Sometimes I'm picking gifts for LPs on stuff like that. Sometimes I'm spearheading creative ideas. So really just depends on the day. And that's one thing I do love about it is no 2 days are the same.
What? Yeah, dude, I guess first question is how do I clone you and hire one of you?
Right.
I mean, in all seriousness, like, you started off by saying that you keep things off of Rob's plate. And my goodness, like those are huge things that you do cover. Investor relations alone, like that alone could be a full-time gig for one person for sure. Onboarding investors, attracting, you mentioned branding, but then also like keeping the rest of the capital stack full in terms of co-GP and keeping those relationships going. Like, dude, you do a lot. That's incredibly cool.
Yeah,
Like,
no, well,
really
thank you so
awesome.
much. And in addition to that, we have our podcast we have together, because I don't know if many people have heard Rob speak before, but it's so nutrient dense, if you will. It's so, compact that sometimes his thoughts really need to be unpacked a bit more and broken down in more simplistic terms so someone like myself can understand it, and much of the audience as well, because not everyone's super privy to the finance world and the commercial real estate world. So having Rob's brain kind of break that down is great. And then in addition to that, I'm also starting a new podcast called Fun Friday, which I'd love to have you on soon as well, where we kind of go through fund managers or operators to kind of discuss the latest and greatest of what's going on and kind of give people their shine. But yeah, no, it's a lot, but it's a great role to be in. And, the way we kind of look at it is if, Rob and Kent need to be focused as much as possible on how can we double the company's revenue, and then, kind of put on my plate the outreach and the other things that can be automated. So I've always kind of wanted to be in sales and, building relationships with people. So for someone like myself, it's really fun. And then I like the creative side and like the conversation piece, like podcasts and stuff. So ultimately it's a perfect fit for someone like myself. I feel very lucky that I really don't wake up every day feeling like I'm actually going to work. I'm doing something that really does give me a lot of purpose. And ultimately at the same time too, I do love money. I do love the economics of the world that we're in and the long-term aspect of, getting some ownership and upside in these apartment deals and naturally with bonuses and stuff that I can invest in these deals, be very lean in taxes. It's really a win-win-win for all parties. So I'm very grateful.
Yeah. Super, super cool. And we were talking before we started recording, you working remote in Phoenix. The company's based in New York City, right?
Correct. Yeah. And so we only buy currently at the moment in Texas, so Houston, Dallas, and San Antonio. So Houston, we have about $400 million of assets there, about 3,000 units. Texas, we acquired our first deal there earlier this year. Sorry, in Dallas we did. And then San Antonio, we're working on some really, really exciting opportunities there as well. So we're focused there. It's nice because I naturally go to Texas so much, but, I kind of float, really everywhere, frankly. And I'm in New York about 3 to 4 months a year, depending upon the year. I just got back from a month stint there where I went to several conferences. So, I do travel so much. So being in Texas a good amount, being in, California, being in Salt Lake City for whatever the conference may be, it makes me geographically kind of a little more centered than being tucked away in New York.
That's super fun, isn't it? Like, I mean, you're getting the taste of so many lifestyle, so many different like ways of life in the United States, with different ways of living. And New York City is like a totally different lifestyle than Phoenix or, Cincinnati or Salt Lake City, for instance.
And to your point, I love it because I get the fast-paced feel of that city, and then get to be in Phoenix where I'm a little bit more of a homebody, a little more mellow. So it's nice to, have best of both worlds, get New York at that level, be with the company, get the excitement and the buzz, and then leave when the weather gets, not as desirable, of course.
Yeah. I need to ask you about the elephant in the room. You're not the eldest of gentlemen, are you?
No.
Okay. Do you mind me asking?
I'm 29 years old. So 29, I'm 29, but I have a baby face as well, which doesn't make it easier.
Yeah, no, but I mean, you are extremely poised and talented and well-spoken for sure, and not for your age, just in general. And 29, by the way, is like, I don't even see that as super young anymore. Like, the way that entrepreneurship has developed and grown and whatnot in the last 20 years or so. But Awesome, man. So, okay. So let's talk about, I do want to actually get your thoughts on the market. We talked a little bit before we started recording about kind of how we're going to approach this and attack this. But I think as I'm thinking about it, I really would. I think let's start with your thoughts on the multifamily opportunity as it sits here in early November of 2023, with interest rates, having more than doubled here in the last 8 to 12 months, I guess, and everything else happening in the economy, uncertainty about recession, et cetera, et cetera. Like, I talk about it a lot, and what my thoughts are on why this opportunity is still, not just still, but like now more than ever, such a compelling proposition. Do you agree with that at this point? What are your thoughts overall?
I think this is the scariest time, which also makes it the most exciting time. And unfortunately, as we know, as history suggests, when raising money is the hardest, the deals are the best. When raising money is the easiest, the deals are the worst. And we're going to come into a time where equity will be very tight. Leverage will not be as desirable as it was before, but the deals will be really great. And these are monumentally awesome times to be in our space and to really make it through and survive and thrive. So we're absolutely thrilled to see, cap rates expanding to where they are right now. I mean, seeing where that is, where we can almost get positive leverage on, deals and, primary markets, not, tertiary or, kind of deals in the sticks, if you will.
Right.
We're finally seeing some price adjustments that are really compelling. We've been fortunate to have basically the bulk, if not all of our properties, all but a couple, in fixed rate debt, which is really allowing us to kind of, kick the can down the road, have fixed rate, more certainty with, distributions and whatnot. We'll be safe. Maybe those deals aren't going to do as crazy as we all thought they would be, or what, exits were, call it if you bought something in 2019 and exit it in 2021 or 2022. But we're really happy with where those deals are, the cash flows that they're distributing. But what makes us really excited is seeing, some distress and pain in the market where we're getting these deals for about 20 to 30%, or looking at them close to 20 to 30% off where pricing was before. And it's not as if fundamentals change overnight on us where, collections are terrible or rents are softening too hard. I mean, granted, rents may soften a bit or flattening out, but where we're, entering these deals at and are about to be acquiring these new opportunities gets us very excited. So we're absolutely thrilled to see what's going on. And we just know, historically speaking, cycles, history doesn't repeat itself, but certainly does rhyme a bit. And we do feel as if the recession kind of coming up here might be consolidated really mostly to commercial real estate, office granted being one of the worst of it. But, there's gonna be a lot of for sellers coming up here, and we want to be the buyer there. So we really want to get aggressive here coming up, really between now and the next 24 months, because you just look at patterns, you look at anyone who, acquired deals in 2009 and 2010, they looked up and like, wow, those are some of the best investments they made. Similarly, we feel like that's the opportunity we have here. So we're, guns blazing, really excited and want to be very active buyers in the time coming up.
Well, and especially I think it's important to note that you guys are in essentially primary markets. Dallas certainly at this point is number 5 or 6 in the country, if not.
Dallas is too hot in my opinion. It's crazy. Dallas still, the numbers, we still struggle to make it make sense.
Yeah. So cap rates are still pretty low in Dallas, right? At this point.
Yeah. Well, and to your point, there was a deal that we liked, we'll talk about market talk here. There's a deal that we liked for $33.5 million. I remember distinctly $33.5 million. I want to say in June, the winning bid ended up being 37.5. Okay. That's a very, very large delta between what we felt comfortable with paying and what that sponsor ended up buying the deal for. And maybe that was a sponsor's only deal that they bought all year. So they were excited. They wanted to be gung ho. Maybe they had a 1031 exchange investor that came in and didn't really care very much and said, hey, I'd rather overpay now as opposed to paying the taxes on it. And I'll just put fixed rate debt on it. And eventually it'll be fine and you'll make money because you're buying in Dallas. But still, without a certain circumstance like that, it's hard for us to feel like that number is justifiable, or even some of the pricing in Dallas is justifiable. There's still best and final processes there. Now we're seeing in Houston, offers as they come, or San Antonio, whisper prices where you could have it at a certain number before, the deal gets locked up if you're a good reputable sponsor. But Dallas is still going through a full robust sales process and cycle, which is still crazy to us, but it's one of the most coveted markets in America. And if you asked and polled 10 people, I bet 3 or 4 of them would say if Dallas is the number one market they'd want to be in, and I would say all of them would probably list it as a top 5 market as to where they want their capital to be.
Yeah, I know, it's amazing. But there are other places like it. Salt Lake City, where I live, is kind of a micro Dallas, where it's just like no matter what happens on the outside, like doesn't seem to affect the internal like combustion rate of what's going on in the economy, right? In that market's economy, that
Absolutely.
is providing a fair amount of insulation from like national and international trends, and like interest rates really beating things up and that sort of thing.
Well, to your point, so half the firm and myself are actually from the Bay Area. So I'm from Menlo Park, California, right next to Stanford University in Palo Alto. Yeah. And I remember tracking the stats just with what the market looked like in 2016 and 2017 when I used to sell homes out there. And interestingly enough, Menlo Park only dropped like 5% during the 08-09 recession, which is, and compared to the national average, it's nothing, right?
Right.
So, and then it springboarded right away. A year later, it was actually above par from what that was at the high from, 2007. So very resilient in and out. Similarly, different areas get different results. So we think Texas and, certain pockets in Texas like Houston, San Antonio, Dallas are going to be really resilient. Obviously, Tampa, Miami are resilient. But much like those markets, to your point, Salt Lake City is incredibly resilient. And some areas will just do better than others because the growth trends are so great. So, where people are moving to, where jobs are going, those places will do better than others. And that's why on our end, we feel very confident that, hey, debt is one thing. Debt, you can't outrun what that will do to your fundamentals and numbers. But the facts remain that, those areas are solid. Jobs are moving there. They're more pro-business. They're friendly. They're better for families to be in. And it's kind of where the country is kind of going. The country is kind of leaving a lot of these coastal markets and going a little bit more central to the heartland of the country. And, of course, Utah, Arizona, Texas are big beneficiaries of that migration.
Yeah, 100%. No doubt. All right. So big picture, what this kind of like point, I guess when you look at your analysis on what you're seeing over the next, say, 12, 24 months, in your words, and the deals that are going to be available, you talked about being kind of just prepared and ready to pounce. What does that look like? What does being prepared right now look like, and how do you make that happen?
That's a great question. So one thing Rob and I have been really trying to spearhead is, if you have the money to go, you can basically buy any deal. That doesn't mean you want to buy any deal, but it's just like anything else. If you're thirsty, you want to prime the pump before you need the water. So kind of what we did when we were going through the raise, and we were kind of a slight period of uncertainty with kind of the big acquisition that we just acquired, the Houston 3 property portfolio, utilizing a unique tax statement on that. In August, we were like, hey, we want to get ready to go. We want to kind of reach out to all of our equity partners. We want to reach out to as many people as we can just to see where they're at. Are they still in the business? Are you a sponsor now? Were you a sponsor that now is looking to raise equity for whatever reason it may be? We wanted to kind of reach out to everyone. So what we kind of did was reached out to basically our entire database and, spoke with them, saw what their goals were, understand where they were at, what they were looking for. And similarly, we just had really great conversations of a touch point and, just say, hey, look at us. We're still here. We're looking to do deals. Are you too? Okay, great. So we got really in line with our people. And actually from that, we also got some referrals and met some new capital partners that we're harvesting right now. So, what that looks like for us is just basically just checking in with people, not only when you have a deal, but just to make sure that they're doing okay and that, they know about us and we care about them, which we do, then more just a transactional deal level. So extra touch points, and then also just calling our investor database, seeing what they need. And, for our deals, if they have any, questions, and kind of just basically making sure that they feel comfortable, moving forward with us, because it is a scary time. It's not easy to overcome what the news is saying when the Wall Street Journal or whatever local paper is writing about XYZ thing, how commercial real estate is going, to heck in a handbag, if you will.
Right.
So it's hard to kind of outrun that. So what we've kind of been doing is just been answering a lot of questions, reaching out to people, sharing our plan, our thesis, and why coming up will be a great time to invest, and getting the well ready, priming the pump. So that's kind of what we've been up to the last kind of quarter. And we got a lot of people that are ready to go, that are seemingly got equity on the sidelines, ready to make it happen and ready to deploy into new deals.
Nice. So who's making those? Who's doing the outreach on those calls? Is that you? Is it Rob? Is there all the above?
The goal is to have Rob never have to do a phone call again and have me do everything in that regard. So a lot of the outreach, where I kind of like Rob to kind of come in is when we get, more JV, institutional level equity players who are kind of in that $5 million plus range, because as we both know, terms kind of get a little bit different, and I can't make those executive decisions without Kent and Rob's approval there, of course. Yeah. And naturally those people, Rob's so brilliant. It's really great to hear how he does that. But with everything basically sub $5 million, that would fall under kind of my jurisdiction. Yeah. And my kind of relationship building there. And then naturally I'll be pinged into any conversation that's higher than that. But at the moment, that's really my responsibilities and roles. So we do, our email marketing. We've got a very robust and deep email list due to the 2 books that Rob has published. So that's been a great source of, people and database there that have kind of flowed to us, that and in conjunction to LinkedIn and whatnot. But I am the one that's making the calls and kind of seeing what's ever going on with everyone. So if you do get a call from Lone Star Capital, it's likely coming from me.
Coming from you. Nice. Yeah, man. Tip of the spear, buddy.
Yeah.
Good stuff. That's where it all happens, right?
Yeah. Well, and that's why on my end, I love to know kind of what's going on with operators like yourself. Like before we got online here, we're just chit-chatting and making sure everything's going well with you. And it is nice to keep your ears to the ground to see what's going on with other operators in different respective markets, seeing kind of what's going on with them, and for us trading notes, because we're pitching, similar IRRs, but we're all in this together and we want to get better together. And, I'm sure there's some investors that we share and capital partners that we share. So it's all about, creating good culture, good community, and making sure that we're all in this together and winning it together. Because ultimately, the biggest thing I think about is this, is if people are having, personal portfolio legacy issues, meaning they're getting capital called here and there, not saying that's what's going on with you or anyone in this conversation, but, if we can avoid that, we don't have to have our investors' good money going after something that might be bad or whatever it may be, right? Mm-hmm. So not getting bogged down by that. So making sure that as people in our positions, to make sure that, investors' capital is safe and we're putting best in practice in place is what it's all about. So sharing and collaborating is super important to us. And as you mentioned, Rob, with the educational information, we're really big on that and working to, put really great information out there to make sure, that the public and people that want to learn about this business are, safe and are putting their equity to good use.
Yeah. Awesome. So I want to drill down a little bit on, since you are, tip of the sphere here, and spear, not sphere, and are having these these kind of, for lack of grassroots conversations, not necessarily the word I'm looking for, but where you're where the rubber is meeting the road between between an investor and an opportunity to invest in multifamily commercial real estate, right? So, what is that conversation like when you're, when you're checking in with, a somewhat savvy, somewhat experienced investor, I guess, not necessarily a total beginner, because as a beginner, you're doing a lot of basic education type stuff, but somebody that's like somewhat experienced, what is that conversation like right now? What are they sharing with you? What are you hearing a lot of, and what are you sharing with them?
Yeah, what they're saying right now is kind of what's going on with their portfolio, whether if they're what operator might be over levered. So it's kind of interesting to hear what their perspective is. And then also they're kind of, saying what's going on with their portfolio. Are they excited? Everyone has a different situation, and, some markets are performing better than others. Right. Yeah. So it's a lot of kind of listening to them. And then, my follow-up question is, well, what would you look for right now? And what would say yes to you? Or, and the biggest thing people are looking for right now for making investments is downside protection. So what people are really looking for is, hey, what does my worst case scenario look like here if I invest in a new deal? Another thing they're asking for, because real estate is such an interesting investment place. You could put your money in the S&P 500 or a risk-free, bond, whatever it may be, or a money market account. But what they're looking for in a deal like ours is, okay, what is my cash flow in the deal? Is the debt fixed rate? So there's more certainty on that.
Right.
If rents slide down, how much buffer do we have? What's break even occupancy? And, what's the depreciation play here? So when you can factor in, cash flow about 100 bips higher minimum than what, your risk-free return will be, that gets them excited. Bips is basis points for those who maybe not familiar with that. But so basically, if they can get 5% in a money market account, a CD or a bond, then they want it to at least be 6%. And then what is my depreciation if I've got to sell some stocks off or, to help my income or tax burden and liability. So they're kind of thinking high level questions like that. What's the debt coverage ratio looking like? Is it well above that 1.25 year one? What's the stabilized yield on cost? So they're really getting into the nitty gritty and, want to understand the underwriting and want to understand, hey, and institutional investors, the super high, the REITs, the pension funds, they're asking, hey, can the deal make sense with zero rent growth for 3 or 4 years? And if you can say yes to that, then they'll really love your deal. So they're asking questions like that and really trying to protect their downside because they know that, hey, some of them have, flowing in a certain amount of money to deploy. It could be $100 million over, 24-month process, and they got to make sure it's good. But the interesting thing about that is they have to pace for it, right? You don't want to just throw all your money up once, but you don't want to also save all that 100 million at the end. It's too stressful. So they have to be dollar cost averaging it out. So they want to make sure that their opportunity is right, and they want to understand, how the investment can go wrong more so than how it can go right at this point.
That's great stuff. Really, really helpful, valuable stuff there. So just to understand where investors are. And so you speak to those fears, those concerns, those priorities, right? So you mentioned cash flow, fixed rate debt, depreciation, and, basically tax advantages. And then I'm sure there's a few that I missed in there, but you mentioned the debt service coverage ratio being at least a 1.25, which is, that's what lenders want to see typically. So you want to be there anyway. Any other important ones that you said that I missed there? I think.
No, you covered a lot of those, and debt profile is just super interesting to them because now things like yield maintenance, now that floating rate debt and bridge debt is not going to be as popular coming up. Although there's an argument to be made that floating rate debt may actually be, if historically speaking, probably the best time to take that out.
Right.
Go figure.
Right.
But figuring out, hey, what's the prepayment penalty? What does yield maintenance mean? Because a lot of people aren't, even they're more sophisticated now, they don't really know what yield maintenance is, or they're starting to learn a lot more and ask a lot more questions. So it's funny, as I'm sure you've seen, hot money has kind of left the space. Right. Yeah. So now that hot money is not there anymore, the questions are a lot more detailed. And, before people would kind of throw their money at everything because of the FOMO factor. Well, now that there's not really much FOMO anymore and money's not as hot, it's more sophisticated people and, it's a lot more following up, a lot more phone calls, texting and wrangling than there was before, where a deal, you could send out a couple of emails and it would kind of subscribe itself. So it's definitely a shift in that regard.
I mean, honestly, like those last 2-3 sentences you just said, or like we could almost like title this episode somehow, like
extra emails.
Like, what? Yeah. I mean, 3 to 7 more touches per investor per deal or something like that, because it is totally different than it was a year and a half ago to raise capital. There is no question about it. And, it's something that we've been experiencing and a lot recently and the multiple deals that we've been getting to the finish line. So,
and it's crazy to think about to that point, not only is, a dollar per dollar is harder, but not only is it dollar per dollar harder, it's the leverage point that we have to solve for now as well.
Right.
Now that, leverage isn't at 30% or 20%, you can't raise 10 million or 50 million to buy a $40 million deal anymore. Yeah. Now, if you're buying a $40 million deal or a $20 million deal, you got to raise, probably about half that in equity. So, if you're buying a $20 million deal, you're looking at raising maybe $12 million now. Before that wasn't the case. So not only is money harder to come by, you got to raise double of it. So those fundamentals in economics don't look as good. Oh yeah, and by the way, because there's less leverage, Guess what we have to train our investors' eyes for now? A lower IRR. Right. So everything is happening in real time where investors feel like they're getting squeezed. We're, struggling to make things work because we've got to raise double the money. But that's the fun of it right now. And, all I can think about is if you can get a deal done right now, imagine when the deal goes full cycle in 4 to 6 years, leverage gets better. You hit a nice 15 to 20 IRR. And next thing you know, you can buy double the deal size with the amount of equity you have currently. So that will flip at some point. It's just a matter of getting to the other side of it.
Yeah. Yep. Survive till 25 is what
yes, sir.
One of the things I've heard a lot of recently. All right. So real quick, do you mind giving me a kind of just a real high level thumbnail sketch view of your investor relations system, if you will, or systems, or if nothing else, just maybe kind of like your systems and processes and anything special that you guys do that you think is particularly valuable?
Yeah. So, it's all relative to what, you're used to, for instance. So if you've been with 5 different firms, if you've been an IR guru from, passinvesting.com to working with your firm, to working with Lone Star, to working with, Rise 48 to ASM Capital now, just to name some sponsors. If you were to kind of go around all there, you would have X, Y, and Z. You probably compare and contrast it a lot better than what I could. All I know is what we've used, right? So kind of how we have it is we use the CRM system, contact management system, where we do a lot of campaigns through it. That's called Active Campaign. Yep. And shout out to Jason Wright. If you're ever looking to learn and use someone great, Jason Wright's awesome. He can give you a plan and a program. So shameless plug there to my boy.
He's been on the show.
There you go.
Yeah, on the show. Yep.
Exactly. So Jason's a guru. He's really great. So we use that. A lead will kind of inbound through there, and I'll get an automatic notification saying, hey, new investor form filled out. Are they accredited? What are their goals? And then naturally, I'll call them right away, leave a voicemail, send a text. Then I'll also send an email with my calendar link. So that's one way we do it. We send email campaigns directly through Active Campaign as well. And then we use Appfolio to have people kind of invest through us. That's the portal that we use and utilize. So those are some of the systems that we use. Yeah. And then kind of what I do, and this is kind of, everyone has a different way of managing their prospects with reference to, following up, but we'll do kind of a mail merge via Outlook, where we'll upload, a deal. We'll send that out to our respective investors, capital raising partners. Usually start there. We take kind of the big stones and then the smaller pebbles and the sand at top. Usually speaking, the sand at top's kind of our investors that might invest $100,000 to $500,000. And then the big stones are those $5 to $2 to $6 million checks or beyond, right? So we'll send that to those partners, and then they'll kind of email us back saying they're interested, and then I'll, in my own calendar, a week later, set a reminder to do a follow-up. So my follow-up will look like, 20 people in a week, 30 people in a week. That's what it looks like. Say, hey, did you get a chance to review the deal, to follow up with people and whatnot. So that's how I personally do it. And then I kind of move them down the line. And then also there's kind of a capital stack feature and filter to a deal in Active Campaign, where we'll send out the blast. We'll upload those people into Active Campaign. And then if someone says they're not interested, you drag them to the top. They're eliminated as a prospect. If they're interested, you move them across and for whatever their respective tranche will be. Let's say if they're raising $10 million, or if we're raising $10 million for a deal, we'll put them in for $1 million for the commitment, and we can kind of mentally see where they're at, who's raising for what, and we'll have a running Rolodex in that regard. And then obviously we're a little bit old school too, and we have to use some Google Excel spreadsheets so everyone can kind of see it as well. So those are kind of some of the tools. Hopefully that was a appropriate enough answer for what you were seeking.
That was great. That was great. No, it was I really like, one big takeaway for me is what you do with a lead the second that you get it. It hits your email through whatever like harvest mechanism you're using, whether that's a click magnet or whatever, people hearing you on this podcast, checking in with your website, getting in your investor club, however that works. You get the lead. You said you call them, you text them, and then you email them with your schedule link, your scheduler link, Calendly link or whatever. That to me is like, that's money right there. Like takeaway, big time takeaway for listeners. Like that's called world-class follow-up right there in my book. And Sterling White, my buddy, invented that phrase, or I don't know if he invented it, but he's the one that
patented it. At least.
Yeah. And to me, that's what it takes. Like that kind of pro level, immediate sort of follow-up. And like I'm preaching to myself as much as anybody right now, because that's, that's systematic, like call, text, email, scheduling, boom, 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 boom. Like that's it. You're covering all the bases right there.
Yeah. Well, and to your point, it's too competitive, right?
Yeah.
Too many people are trying to raise money from, the similar folks. And if you do a Google search, let's say you're looking for, Texas multifamily, we're not going to be the only people that come up. So how do you distinguish yourselves? It's by great customer service and, a human calling you on the other line and really reaching out. So we want to make sure that we really harvest and convert those people. And, the great thing is that a lot of times we're getting a lot of referrals now, but also it's people that maybe been tracking us for some time. And, fortunately with, the education that Rob's been doing, or, I'm sure even yourself, you probably have people that have listened to your podcast for so long that, may didn't realize they're listening to it, or fund managers that want to, work with you now because of the show, because of the information you're putting out. It's an easier conversation when they already kind of have a guideline of who you are. Then they just want to know that you're a real human and that there's not some, internet scheme prior to them maybe working with you, investing with you. So I think doing that really offers that solution and solves for that.
Yeah. It's outstanding. Well, speaking of all that, what's the best way for listeners to get in your ecosystem, Lone Star's ecosystem, and connect with you and learn more about what you guys are doing?
Yeah, well, thank you so much for asking. So naturally, Rob and myself are very active on LinkedIn. So just my first name, Craig, last name, Mcgrouther. If you want to add me on LinkedIn, Rob Beardsley on LinkedIn as well. And then if you want to go to our website, lscre.com, if you want to kind of learn more about us there. And then additionally, Rob and myself have a weekly podcast show called the Capital Spotlight Podcast, which we kind of go over current events, what's kind of going on with us, a little bit of fun lifestyle, information, and kind of how we see the world a bit, which is kind of interesting. If you ask me, if you ask other people, they don't care, but that's them. And then finally, I'll be starting a new show, which hopefully will have you on before the year ends, called Fund Friday, where we'll have respective fund managers and operators and friends in the business and industry coming on and sharing their thoughts and insights. So yeah, that's how you can find us.
Awesome. Yeah. So the name of yours and Rob's podcast again is Capital Spotlight
Podcast. Yes, sir.
Capital Spotlight Podcast. So yeah, guys,
yes,
check that out there. Definitely follow these guys on LinkedIn. And listeners, if you're not on LinkedIn and you're not like a presence there, you're missing something big, is all I got to say. Like there's a lot of blue ocean on LinkedIn, in my opinion. And pretty much everyone that's anyone in this space is on LinkedIn. I'm sure there's exceptions to that. I'll probably get an email or two, but I'm just a huge believer. And I heard Gary Vee say something about LinkedIn's kind of where Facebook was about 12 years ago.
LinkedIn right now, we're in the golden era of it. We don't know how long these kind of things can come and go. I think LinkedIn has a lot of staying power because it's not trying to be trending. It's trying to be what it is, which is work related. But we're in the golden era of LinkedIn. Take advantage of it while we have it. It could be a decade longer. Who knows? But LinkedIn is such a beautiful and valuable source. Yeah. And the funny thing about LinkedIn, I've noticed, is that it's become quasi social media, quasi Instagram, quasi Facebook, but you're allowed to be on LinkedIn if you're anything, if you're in the work, if you're in the corporate world, you're allowed to be on LinkedIn. You can't get in trouble for it. Therefore, I think people are on LinkedIn extra because of that. They want to kill some time. So make sure your content and information is there. Please, you're taking money out of your pocket. Yeah.
And so again, connect with Craig. Craig is Craig. McGrouther is McGrouther. So connect with them on LinkedIn. Check out their podcast. Also, you can still get a book on your website, can't you?
Yeah. So we have the Passive Investor Guide that is free. And then the book, you may have to pay for that there, but we do have the proprietary model that Rob created. We're a big fan of free information out there. We want to have good culture and, be representing the brand of the business well, if you will, in the syndication space. Rob's underwriting model has been downloaded over 10,000 times, and it's there for everyone if it's available. So feel free to utilize that if you're looking to learn more about underwriting. And in addition to that, he's got just a wealth of information in reference to training and, learning about multifamily real estate and whatnot and how the underwriting works. That was actually my training guide. So that is all what I learned to learn the business is all there actually. So Cool. It was good enough for me. It's good enough for probably everyone else as well. So I highly recommend folks who are looking to learn a thing or two to please leverage and utilize those resources available.
Yeah. Great stuff. So lscre.com, guys, lscre.com. You can download the underwriting model. You can download the passive investor guide. You can order the books. The books, by the way, Structuring and Raising Debt and Equity for Real Estate by Rob, like now more than ever, right? Like that's so valuable and incredibly important. So I guess kind of on that note, to kind of wrap us up here, Craig, when you look at particularly the equity side, the capital raising side on, the retail LP level, right, is there a secret sauce or a magic bullet right now? And if there's not, like, what do you see as like, kind of the key ingredients? And some of this may be summarizing what you kind of already shared, but just the key ingredients to success right now in raising capital.
The key success right now, I would say, as it is right now, November 6th, 2023, don't know when this will come out, but we'll timestamp it for future reference. So hopefully it'll look good, is you're going to have to work 3 times harder for the same result that we had the last couple of years, but be resilient, keep your head down, do the right deals, stick to your fundamentals. Don't be in a rush to make a bad decision. Be very smart, be very strategic, and stick to your fundamentals, stick to your guns. Good deals are coming up, but be disciplined and keep your head down. Yeah. That's what I will say.
Yeah, I like it.
Follow up.
Yeah, bingo. Right. The only other thing I would say is like, be like really connected to your messaging in terms of what is it? What is your message right now? And like, in my opinion, what it should be is why multifamily is such an amazing opportunity right now, given our current situation and the economy and everything else. And if you believe that message and you're sharing that on any and all ways that you can, it'll serve you really well. I think it's an education point. And being convicted about what you're selling is so key in life in general. So
gotta love what you're cooking. And to your point,
right.
I'm very curious to know, what have you kind of been saying on your end when you're speaking to investors and capital partners and people that may be scared or concerned, or might be getting capital called, or just not feeling great about their positions right now? What are you kind of saying to talk them off the ledge and make them feel comfortable with what you're providing, what we're providing in the industry right now?
Yeah, I mean, I think the points that I make with people that are new to looking at the opportunity are things like hedge against inflation, recession resilience, some people say recession resistance. I'll typically just quote the facts in terms of performance through past downturns, economic downturns in the multifamily sector. And just talk about how it's a very risk mitigated opportunity if you're buying right with the right sponsor, of course. So those are the key points, obviously, is to make sure the sponsor's right, make sure the deal's right. And if you're doing that, I think I agree. I think now, as much as ever, and especially over the next year or so, at least, is going to be as good a time as maybe we'll ever see to buy. So
yeah, and it's funny. Our friend Hunter, which you're part of Raise Master, said, you look at all these people who bought deals and had the crazy IRRs when they acquire deals. Well, what's a cheat code? You don't deserve to use that deal in a resume in 2009, 2010, 2011. It's like, well, no. Now we're at the play. Now we get to play the game where we can have these crazy IRRs. So now it's time for us to take advantage of it. And just because if you got maybe beaten up or a deal didn't go as well as you thought before, That happens. Projections are projections for a reason. It's not fact. Coming up now, though, this is the time to get into it. This is the time to work with an operator like yourself, to work with an operator like Lone Star Capital, who is responsible, who has been in the game for a bit, knows left from right, and to really, work with the pros, which you are, which we are, which, we're excited for the opportunity.
Yeah. Well said. All right, folks. Well, there you go. Craig McGrouther, everybody, from Lone Star Capital, and zooming in from Phoenix today. And Craig, really appreciate all the wisdom and knowledge and experience and just really innovative thinking that you brought to the show, man. Totally appreciate it.
Thank you for having me on. And I look forward to having you on my new show coming up here, hopefully by the end of the year.
Yeah, can't wait. And listeners, thank you as always. Appreciate you guys, and we'll see you on the next episode. Take care, everybody.
This has been The Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.